Yeah, I mean, I think it's a very important development. Obviously, the majority is very slim in the Senate, as slim as it could possibly be. And also in the House, the balance is obviously also shifted, but still in favor of the Democrats. And so I think what the market is reacting to correctly, and this to me is the most obvious market reaction, is the potential for further fiscal spending from the administration, unencumbered by a split party leadership in the Congress. And so for me, it makes sense that you see the yields rise and yield curve steepen. I would also note that break evens, right, which are the expected inflation for the next 10 years. If we look at that, that has gone up from right before the election from about 170 to now over 2%, 2.1% roughly. So it's a build-in of expectations, a build-in of higher yields, but we would still maintain very much the view, and this is our new nominal investment outlook, is the idea that it is unlikely that rates are going to move materially higher over the medium term, particularly given policy, and in particular in the U.S. monetary policy, where the Fed is very keen on keeping financial conditions easy so that the recovery as part of the COVID recovery will remain in train. And so, yes, we do expect inflation expectations to increase as we've seen. We expect rates to increase, but moderately. But we don't expect any change in policy in reaction to that inflation, which I think is a very, very important distinction when we look at the markets currently relative to, let's say, a normal cyclical economic cycle, right?
Right.
We're reacting to the health crisis, and the Fed is not going to put the brakes on by increasing or letting rates get too high in this environment. And therefore, that's a very positive environment for risk assets. And obviously, you add to what you mentioned before, the idea about more fiscal spending coming,
Right.
which I think is also the clear outcome.
Well,
Yet you see higher rates, steeper
you and
curves.
I actually spoke about this concept of the new nominal about a month ago. And obviously, since
Yep.
then, we have seen these reflationary trades pick up steam, and there seems to be some good momentum behind them. To your point, though, you don't think that these rising inflation expectations are going to incentivize the Fed to act. That being said, many analysts out there are now bringing forward their timing of the first rate hike because they're saying, well, inevitably the market will actually pressure the Fed to do something. Do you think we could end up in that type of situation where real yields start rising to the extent that the Fed do become a little bit trapped by this rising yield situation and have to do something about it?
Yeah, in the medium term horizon, I wouldn't agree with that thesis. What I would say rather is the opposite, which is that the Fed is very focused on keeping financial conditions easy as the economies recover from this enormous, health shock and economic shutdown. And in some respects, I would suggest the market participants will test the Fed on that. And they will test to see what the resilience is or what the view is around the Fed in terms of the ability to manage yield. So I think the actual first order of business is to watch as the market tests the Fed in terms of rising yields to see if they're still where they are in terms of managing the yield curve. This idea of yield curve control, rates are above 1%, which the market had discussed as a potential entry point for the Fed to come in and start to manage that. And obviously, they've left the door open for that in the December FOMC minutes. So I think actually the first order of business will be to see how the Fed reacts to higher rates by keeping a lid on too quick a movement up in rates.